Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb. This week I'm speaking with Luca Paolini, Chief Strategist at Pictet Asset Management. Now, before we start, I have to tell you that we are recording on Wednesday, May 13th, late afternoon, British summer time. And I'm being this precise because there is so much going on, so much in flux, that by the time you listen to this, everything could have changed. So the UK Prime Minister Keir Starmer could have resigned. Donald Trump will have been to China, probably have been to China. The US-Iran standoff may have made progress, may not have made progress. Who knows? So there's a lot of possible changes between right now and publication. That said, I still think there's a lot we can get from Luca today. There's an awful lot we can talk about that ignores those changing issues. So, Luca, welcome to Merryn Talks Money.
Oh, nice to be here again.
Right, as I say, there is quite a lot going on. So let's talk first about the macro environment and how extraordinary it is, really, how little markets are reacting to the sort of rolling crisis in the Middle East in particular.
Well, I think the main story here really is that when you look also the experience of the last few years, every shock that we are seeing globally, especially the tariffs day and last year, especially US economy has been incredibly resilient. Everybody was expecting a big impact on inflation, on the labor market. The reality is that US growth is above 2%. Even Europe is growing in a decent rate. Japan is recovering. China is fine. So the global economy has proved to be incredibly resilient. It's a surprise to all of us. But obviously the resilience of the global economy also implies that earnings are doing very well. And so looking at the past, investors draw a simple conclusion. It doesn't really pay off to be too bearish too soon. And that's why I think the market continues to be very, very, very strong.
But what do you think is driving that resilience? I mean, you know, if you watch the news, you hear relentless drive of negativity, for example, and look at employment numbers and all that kind of thing. You begin to worry that AI is eating into employment, which is going to be a long-term problem. There's an inflationary impulse across the globe. Rates are more likely to go up than down. All these things should be negative for the global economy, but nonetheless, as you say, it's relentlessly resilient. Why?
I think partly because, let's not forget, the AI boom is not just, market prices going up. It's a real increase in investment spending that obviously drives all the economic data higher, not only in the US. Then there is another element which I think is important, is an incredible creation of wealth that's been achieved the last few years. That basically implies that people have more money to spend, even if the global economy or some indicators are not looking good. But I have to tell you that there are some strange indicators in a way. If you look at the consumer confidence in the US, it's an all-time low. It's even worse than in the 70s and the 80s, lower than in 2020. So people are clearly worried. Inflation is picking up. But again, when you look at GDP, the normal indicator we look is still very solid. And I think that's what drives market. And I think for us, this kind of positive macro outlook is set to continue.
Okay. So even with that resilience of the economy, and we know, of course, by the way, don't we, historically, that it's not necessarily the case that economic growth and market returns are correlated. That's not true. It's all about where valuations begin. So, but even with that economic growth, looking at stock markets, and let's look particularly at the US, there's definitely a valuation problem there.
Yes and no. So it is true that when you look at for example, the price to earning ratio of 21, well, it's the long-term average is 17, 18. But let's not forget that we have a private sector or a corporate sector is incredibly profitable. You have earnings growth of 25%, record margins, buybacks, taxation effectively going down more than up. So the fundamental story is very, very solid. I wouldn't say that U.S. Market is cheap, but it's not incredibly expensive. And where I think we see some area of excessive valuation, not in the tech sectors, is in stocks, in some consumer stocks that trade well above the market. And I think this is where I think it becomes interesting. Tech looks expensive, but again, if you assume that this kind of capex story, the AI story will continue, the valuation is not that extreme. And that's why we think that, the valuation element is kind of a negative, but not negative enough to offset, all the other positive that we mentioned already.
Okay, and do we assume that this capex boom can continue? And we can assume that capex boom will continue, but can we assume that returns on it will be what everyone expects? And we've done some podcasts recently on AI and on the huge build out and on the limitations of LLMs and the possibility that the capex build out may be something of a false start.
I think if you look over the next 5 years, probably. I think these numbers cannot be sustained. We're talking about, investment in AI, in data center, close to 1 trillion this year in the US. This cannot go on forever. Can we though expect a significant slowdown in the next 6 to 12 months when you already had pretty much clear commitment by the top tech companies that will? Probably not. So I think that the CapEx story is solid, and I think the question would be, will other sectors benefit from that, some industrials? And our view is that this CapEx story will get a little bit broader, and that will support growth for at least for the next year.
Okay, and then earnings across the board. You said earlier, we have these extraordinary earnings numbers, extraordinary margins. They're all at historical highs. And I know that we've all been looking at profit margins in the US for years and going, look at that, they're, totally out of whack. This has to revert to the mean, etc. And they never do. But at some point, it feels like there should be a turning point. Not yet, but...
Yeah, I think what is interesting about margins is that they're not high everywhere, even in Europe, UK, Switzerland, China, Japan. At the lower level in the US, but an all-time high. So there must be something else. And the something else could be real pricing powers. A lot of industries are effectively not very competitive. There are just a few major players that actually can effectively dictate prices. I think they have huge margins. There is a decline, I think, in wage costs, in a way, in real terms at least. There are buybacks that help. So it's a more fundamental story. I don't think that, again, this is sustainable. At some point, there will be a political backlash probably, because I think voters will not accept these companies to generate a huge amount of profits, and when actually a lot of people are struggling. So, but
it feels like that political backlash is kind of underway.
Yes, but you don't see this translating into, let's say, anti-business kind of policies, right? And I think that's probably what can change. One could be that global growth will get weaker and profit margin will, or there will be a change in taxation, in the redistribution of wealth. But so far, it seems a very solid trend, which is very difficult to expect to stop. And that's why I think the market is well supported.
Yeah. And do you believe that those earnings numbers that we've seen, extraordinary earning numbers we've seen in the US so far this year, that they are sustainable? I mean, because you could argue that the bubble is not in the P bit of the valuation, but in the E bit of the valuation.
Well, I think, look, when you look at the earnings that we've seen, tech is up almost 50%, but all sectors are up. So is it sustainable at this rate? No. In fact, we think that the expectation for next year, another 20% increase, is probably too high. But again, this year has been, in a way, exceptional. We expect some deceleration in earnings, but we still earnings that are well above the historical norm. So you need to see more for markets to decline, and probably to see more, you need to see a significant slowdown in the global economy.
Okay, let's look out over the next decade. We were talking before we started the podcast. We were talking about forecasts over the next 10 years or so, and you were saying that doesn't look completely comfortable.
Well, yes and no, in the sense that, when we got used to see equity returns between 10 and 20%, historical average between 5 and 10. And historically, when you see very low risk premia, as it is now, you cannot expect significant returns in the next 5 or 10 years. So unless we are in a new kind of world with low inflation, AI pushing growth to 3-4% per annum level, I think you need to see at some point some deceleration in the returns. What is interesting is that when we look at our indicators in terms of valuation, expected growth, monetary policy, there is a significant convergence across different regions. So we talk a lot about this multipolar and this kind of fragmentation in the geopolitical order. The reality is that from a macro point of view, there is actually quite a significant convergence. US is probably going to get a little bit worse, Europe a little bit better. Valuation has kind of converged. So if valuation is similar in a way, has converged, and the global or the macroeconomic cycles are converging, you should expect returns to be pretty much converging too, but below the historical norm. So it's going to be in a way difficult because return will be lower, but I think it will be more kind of spread out than now, which is basically driven by the US. So the time where the US was the only place to be invested is probably over. And I think that's the key message for investors in the next decade.
Okay, so what does that tell us as ordinary investors? It tells us we should be diversifying away from the US. Does it tell us there are any particular markets we should be heading for?
Yeah, you have to diversify away from the US, not because we expect US stocks to do particularly badly, but because of risk consideration. So if you are passively invested, let's say you're based in the UK, you're passively invested, you end up having 70% almost of your asset in a market that is not even denominated in your own currency. So there is a risk, market risk, currency risk, political risk,
sector risk, because so much of that is in the tech sector dominated.
Exactly. So I don't think it's worth taking this kind of risk. So I think having a more equal weight approach, reconsider your allocation, and to have maybe even on bias, I think it would help. And also, let's not forget that when you look at as an investor, we tend to focus on equities because that's where you tend to get the best returns. But now, if you look at where bond yields are in UK, but also in the US, you start thinking that you can probably also maybe take some profit out of equity and put it into fixed income. Because I think now, for the first time, I would say in a decade, the expected returns on fixed income products are actually quite attractive, not only in the UK, also in the US. So I think maybe it's time also to put some money back into the fixed income space.
I was going to say, quite brave to get into the UK bond market right now.
It's always, that's the difficult part of our job, right?
Yeah.
I think when you look though at the UK, you look at gilt yields between 5 and 6. In real terms, it's like India. So effectively is the same real yield that you have in India. And if you look at even the everybody's talking about, the problem of debt, the fiscal situation. And I'm not taking my own number, I take the number of the IMF. The UK is in a much better position, definitely the US, even Europe. According to the IMF, not myself, the UK will have a primary budget surplus in 2 years' time. Maybe it's not going to happen. The point is the fiscal situation in the UK is not fantastic, but it's not as bad as everybody think it is. So I think there is some good value in gilts. The timing is always
I suppose it's perceived as bad because no one quite believes that fiscal surplus will exist based on current policy.
Because of political instability, you don't know who's going to be in charge. Obviously, you pay the price for that. But the point is that when you look over the next 10 years, there are a lot of political cycles. I think there is still good value in UK bonds.
Okay. And in equities, is there any market that stands out to you?
Well, when we look at now, I think the US is still the best bet. Again, you have a good economy. You have probably potentially some rate cuts, earnings growth at 25%. I think everything seems to be going well for the US. Emerging markets too. And this is not just Korea and Taiwan. I think we see a decent improvement in emerging markets. Some emerging markets are already cutting rates, good valuation, cheap currencies. So I think it's EM and US are now the place to be. If you extend your analysis over the next 5 to 10 years, there is also a case for Europe. Europe is kind of, especially Germany, is going to spend more, cheap valuation. I think we also feel more optimistic than others on the integration story, reforms. It's difficult to invest in Europe, we know. But I think if you extend your analysis, I think everything seems to be going very slowly in Europe in the right direction. And I think the market is not still kind of priced for that improvement.
We're all just too depressed about Europe and the UK.
Yeah, because actually the history tells you that it's not worth investing in Europe. But, at some point things will change. And in fact, when you look at the performance of Europe versus the US, but even the UK, you look at the past 5 years, it's not a big difference. So I think it's important to highlight that, not everything is bad in Europe, but obviously, there is a reason why Europe and the UK trade a significant discount to the US. We just think that this kind of discount is a little bit too wide.
And things should change for the best.
Yes.
What about commodities? I mean, obviously the energy market is of great interest to everybody at the moment, but across the board there's renewed interest in the commodity sector and talk of a new super cycle in commodities, etc. And a lot of our listeners are particularly interested in gold.
I don't believe in a commodity super cycle. If you look, the last one was driven by a huge increase in investment in China, especially in the real estate, which is very commodity intensive. The current capex cycle is less kind of commodity intensive. You still need, especially industrial metals, not by chance, industrial metals trade at an all-time high. So you have to differentiate. I think the gold price is set to increase, not at the same pace. The dollar has already depreciated a lot. There is limited downside on rates. if the geopolitical situation improves, I think gold still has the potential to do well, but not at the same pace of the last few years. The oil price, I think, is trending down, unless something go horribly wrong, obviously in the Middle East. Where I think the most interesting bit on the commodity side is industrial metals, because I think you can claim that industrial metals are critical in the green transition. There is limited supply, strong momentum. That's probably the area of the market which I think is more interesting. But betting on a commodity super cycle when growth is okay but not booming, I find it difficult. But at the same time, we tell our clients that a position in commodities is required, especially in gold, because if there is a spike in inflation, you still want to have
You'll be
exposure
glad you
to
have it. Yeah.
Yeah, I mean, it's something that, you know, sometimes when you look at your portfolio, you don't want to just pick the asset class that will do necessarily be the best, but the one that can give you some protection if something goes wrong. And I think commodities, I think, fit this kind of description.
Yeah. So when we were talking earlier about Europe and the UK and reasons people don't feel particularly comfortable investing in them, one of the reasons that people often give on pod is because of the extremely expensive energy prices in Europe and in the UK, and that makes it very difficult to think, well, these are the places that are going to grow incredibly fast in the future if economic activity is energy transformed, etc. Is Germany really the place to be? Is UK really the place to be? Because it's hard to see great growth on the back of that kind of price.
Well, I mean, Europe roughly imports 3% of GDP, so that's the cost of the import bill in terms of energy. So 3% of GDP is significant. The US is a net exporter. There is one positive element to all this. First of all, is that we expect, first of all, oil prices to decline, but also the fact that renewables are playing a much bigger role. That means that Europe, slowly, with time, potentially by 2040, will be energy independent.
Assuming battery technology develops
Exactly.
in the way everyone
it takes
hopes,
time.
etc.
I mean, it's 2026 to 2040 is a long time, but I think Europe is going the right direction. My worry about Europe is that this process of, there are also real reforms. Another example, you look at the periphery today, looks even more solid than the core. So we tend to forget that Europe has done a lot in the last decade, but it's still too slow. The risk that I see for Europe, partly even the UK, that you need another existential crisis for the actual reform to be implemented. And hopefully it's not going to happen, but that's my worry, that we are still too comfortable in Europe and the UK to make the decisions that we have to make. Again, I hope that Europe will go in the right direction without a crisis, but I feel that we need maybe more pain
might drive
before.
this existential crisis, a fiscal crisis, presumably of some kind in the UK.
I don't know, because again, the UK, of course, is all about the political environment, because UK, we are very dependent on foreign capital, something that Europe is not, for example. But at the same time, I feel that the real risk, political risk, is more in the US. When you have, people tend to forget that, especially in the euro area, the debt to GDP ratio is the same of 10 years ago. In the US, it's 20% higher. The US is where you see an exponential increase in public debt, not in Europe. In Europe, the problem is that we don't spend well what we have. In the US, there is an exponential trend, and there is no sign of this being changed. So I think of the US, because you have the dollar, the reserve currency, there's still a lot of capital inflows into the US, but this is where I think the risks are, more in the US than in Europe from a fiscal point of view.
Interesting bit. I mean, you and I have had this conversation before. We've been worrying about this in the US for decades, and it just keeps going. It's fine. So why would we worry now?
Because the US is less, you can't trust the US in the same way you trust the US a few years ago. And when you're very dependent on foreign capital, that's true also for the UK, you cannot treat foreign investors in the wrong way. And that's the perception. The perception the US is not the safest place. It's still the safest, the best place, but not as good as it was before. And so I think if you just, again, we talk about diversification. Even if a small portion of foreign investors are diversifying away from the US, this is a huge implication in terms of bond yields, valuation of equities. We don't expect anything crazy, but we think that we already seen the peak of US exceptionalism, and the US will, I think, already lose the dominant position in a lot of areas, right? And so I think that that's what can trigger potentially, and we don't expect a fiscal crisis in the US, is investors getting worried about a dollar depreciation, the Fed to lose independence. This could be a significant trigger for potentially a fiscal crisis. We don't see this happening, but that's one of the risks that we have for our sector outlook.
Okay, I was going to ask you what you thought the biggest risk was out there, and I suspect that that's the one.
Yes. Yeah. Sorry. Yeah.
So leaving that, what is the thing that you think might happen that might make everything absolutely fine, justify valuations across the board, make these fiscal problems go away? I mean, we often hear from people, but we don't have to worry about anything anymore because the arrival of AI and robotics are going to bump up productivity so much. All the problems that you thought we had are going to vanish.
Well, I mean, there will always be problems, right? I think to me, as an investor, the worry that I have, there is always something happening that we can predict. These are the real problems, the one that we are not prepared. We are kind of prepared for a spike in inflation. We are prepared for some kind of fiscal crisis. We are prepared for an escalation in the Middle East. We are not prepared for COVID, for example. This is the kind of things where, honestly, when I look at the fundamentals, one risk that I see for global markets is that we are, in a way, too dependent in terms of wealth creation of what the stock market is doing. So it's for whatever reason, and we see actually with AI, there is a disruptive force that can potentially create a big shock in the market. It will have a huge implication also for growth. So in a way, the correlation has changed.
Yeah,
is
the market
that can have an impact on the economy. That's to me, and this can happen on a daily basis, and we can't predict that. That's what I'm really worried about. Some more a market shock affecting the global economy than the other way around.
Okay. All right. But generally speaking, you're relatively optimistic that everything will hold together, but we'll see just lower returns over the next 10 years than we have over the previous 10.
Yeah, we had basically 10 of 20 years of superior returns.
Yeah.
I think this is not going to happen again. And if you have 7% return on equities and inflation is 3%, it's not bad. It's just that we shouldn't get used to 20% because that's not sustainable. If it happens, what happens is the inequality will rise and the risk of economic populism will grow. So I don't think it's actually good for us as a society to have a long period of superior kind of return from equity, because this will generate political tensions.
Yeah, we want better GDP growth per head and maybe less growth in the stock market. Yeah. Luca, thank you.